On Friday, May 16th, after the market close, Moody's Investors Service, one of the world's most influential rating agencies, downgraded the U.S. credit rating to AA1 from AAA. This sent Treasury yields up sharply on Monday morning, it hit the already weakened dollar, and it briefly rattled the stock market. So let's break down why this happened and what it means for investors. People have credit scores and businesses and countries have credit ratings. Both help to signal how big of a risk a lender is taking when they loan money at a specific rate over a set period of time. A country with top AAA ratings should be able to borrow money more easily than one with weaker credit ratings and at some of the lowest rates available. A downgrade would signal those borrowing costs are going to rise, making it more difficult and expensive for a borrower. The U.S. budget has been exceeding its revenue for years. As of May 2025, the total debt was at $36.2 trillion. That's about $1.6 trillion more than a year ago, and almost $11 trillion more than 5 years ago. Social programs have expanded as the population has grown and aged, while elected officials have favored tax cuts. Moody's pointed to U.S. spending and interest costs that have been rising for a decade as a reason for becoming the third and final credit rating agency to cut its U.S. ratings. The Treasury market has been under pressure. Yields started rising in 2021 as the Fed talked about increasing interest rates from near zero. Then in 2024, investors worried that a Republican sweep in November's election could result in tax cuts and other policies that would grow the U.S. deficit. But in 2025, after President Trump shocked markets with his April 2nd reciprocal tariffs, they suddenly rose even more. The Moody's downgrade was another blow for bond investors. The 30-year Treasury yield on Monday morning briefly topped 5%, a level previously seen during periods of market stress, including the 2023 regional banking crisis. While investors were on edge about Moody's downgrade, on Monday, stocks actually recovered the earlier losses to end mostly higher. But if longer-term bond rates are higher, it can hurt corporate earnings, and that could damage the optimism we are now seeing return to the stock market. Higher yields would make it more expensive for corporations to borrow money, and at a time when they are also trying to manage the costs associated with Trump's tariffs. On the bright side, the credit downgrade isn't really coming as a surprise. S&P had already lowered its rating for the U.S. in 2011, and Fitch lowered its rating in 2023. In 2011, it was a shock, and a lot of financial contracts, like loan documents, included language that hinged on AAA credit ratings. So it was a huge disruption at the time. But after that, people in the market began avoiding that type of language as much as possible, which meant that after Moody's downgrade, there wasn't signs of forced selling. Now the U.S. has a AA rating, which is Moody's second highest. And while the U.S. may be tarnished by the downgrade, the financial hit isn't expected to be as bad as it would have been if it had come out of the blue. The dollar and U.S. Treasuries are still considered among the world's safest havens, even if they're more tarnished by the recent tariff fight. The high standing and deep reach in markets keeps the government's borrowing costs at bay. But the question is, for how long, given that the U.S. isn't expected to handle its growing deficit until it has to?